Something very unusual is happening in financial markets. These two lines have been diverging sharply. This line represents the US stock market, which has risen by 10% since August 2025. And this one represents Bitcoin, which has fallen by 25% over the same period. What this tells us is that Bitcoin, which is a high-risk asset that typically outperforms during bull markets, has been underperforming even as risk appetite in equities has improved. When we zoom out, we can see a similar setup heading into the 2021 bull market top. Stocks continued to move higher, while Bitcoin began to lose momentum. That divergence preceded a 75% bear market decline for Bitcoin, an outcome that many investors fear could repeat today. But to evaluate if this is actually a bull market top, we have to look at two key liquidity factors that significantly influence Bitcoin. The first one is the Fed funds rate. This chart shows the benchmark interest rate set by the Federal Reserve. When interest rates are falling, borrowing becomes cheaper, financial conditions ease, and capital tends to flow toward risk assets. And when rates are rising, borrowing costs increase, financial conditions tighten, and risk assets typically face more pressure. As we already know, the Fed has been cutting rates since late 2024. But looking at just the direction of the Fed funds rate doesn't really tell us whether policy is actually loose or restrictive. For that, we need to compare it to the 2-year Treasury yield, which reflects where the bond market expects interest rates to average over the next couple of years. In simple words, it acts as a proxy for what the market believes is a neutral level of policy. When the Fed funds rate is below the 2-year Treasury yield, it suggests monetary policy is accommodative relative to market expectations, meaning the Fed is keeping rates easier than what the market thinks is appropriate. And when the Fed funds rate is above the 2-year Treasury yield, it suggests monetary policy is restrictive relative to market expectations, meaning the Fed is holding rates tighter than what the market believes the economy can comfortably handle. Now, it's important to note that this can occur regardless of whether the Fed is hiking rates or cutting them. This comparison isn't about whether rates are going up or down. It's about whether the Fed is positioned tighter or looser than what the market is pricing in. A clearer way to look at this is through this line, which takes the Fed funds rate and subtracts the 2-year Treasury yield. When this line is above zero, it means monetary policy is restrictive relative to what the market expects. And when this line falls below zero, it suggests monetary policy is accommodative. Since 2023, this line has remained above zero. That tells us that even though the Fed has begun cutting rates, it has not been cutting them fast enough relative to where the bond market expects interest rates to be. The only other time we've seen a similar setup since 2014 was in 2019 and early 2020. When we put Bitcoin's price on top, that period aligned with a rally followed by a mid-cycle correction. That correction ultimately proved to be a buying opportunity though, because Bitcoin went on to rally more than 500% once this line moved below zero. Bitcoin only put in its actual bull market top when this line reversed from deeply negative levels and began moving higher, signaling tighter policy. And we also saw the same development during the 2017 bull market peak. Today, we are still in an environment where the Fed is signaling looser monetary policy ahead. In fact, Trump is set to appoint a new Fed chair in May of 2026, someone who is likely willing to cut rates aggressively. That makes it more likely that this line moves lower from here. So based on this chart, Bitcoin's current correction looks more like a mid-cycle correction rather than the early stages of a bear market. Now, the second factor we need to consider is the Federal Reserve's balance sheet. This chart shows the total amount of assets the Fed holds, which is another way of seeing how much money the Fed is putting into or removing from the financial system. When this line moves higher, it reflects quantitative easing, meaning the Fed is adding liquidity to the system. When the line moves lower, it reflects quantitative tightening, where liquidity is being removed. And when the line moves sideways, liquidity conditions are broadly neutral. If we overlay Bitcoin's price on this chart, we see a clear relationship. The last 3 times the Fed was expanding its balance sheet, or at least keeping it stable, Bitcoin saw strong upside moves. And when the Fed's balance sheet began contracting, those periods aligned with bear markets on Bitcoin. What's interesting about the current bull run is that it has occurred while the Fed's balance sheet continued declining. We've only seen something similar 2 other times in Bitcoin's history, once in 2012 and again in 2019. In both instances, Bitcoin rallied by more than 250% despite the Fed shrinking its balance sheet. Of course, neither of those rallies made it to new all-time highs like we've seen this time, but this could also be a consequence of accelerating adoption by institutions, treasury companies, and sovereign wealth funds, all of which are unique to this bull run. Now, during the 2012 and 2019 transition from quantitative tightening to quantitative easing, Bitcoin did experience volatility, but in both cases, those pullbacks turned out to be mid-cycle corrections rather than the end of the bull market. Today, the Fed has once again shifted from shrinking its balance sheet to expanding it. It has already begun purchasing $40 billion of short-term treasuries and will reassess this amount later this year. We think there's a good chance this number might actually increase because of the liquidity stress we're starting to see in the system. For example, this chart shows us the total bank reserves. This represents the cash commercial banks hold in their accounts at the Federal Reserve. Since 2021, bank reserves have declined from $4.2 trillion to $2.9 trillion. Based on research from the Fed and bank surveys, when bank reserves fall below 10 to 11% of GDP, the financial system begins to experience liquidity stress. That's exactly what happened in 2019. Back then, bank reserves fell to $1.5 trillion, while US GDP was at $21.4 trillion. That pushed reserves down to just 7% of GDP, well below the 10 to 11% threshold. What followed was a liquidity crunch that ultimately forced the Fed to step in and expand its balance sheet again. Today, with bank reserves at $2.9 trillion and US GDP at $30.5 trillion, this metric has fallen to 9.5% of GDP. Now, there's always a chance this number declines further, but it has already entered the danger zone by falling below 10 to 11% of GDP. So today, we're in an environment where the Fed is moving towards a looser interest rate environment and is simultaneously ramping up its balance sheet with a real possibility that the pace of that expansion increases. That's why we don't view this divergence as a sign of an imminent bear market, like what we saw in 2021. In fact, if we look at 2019, we can see a similar divergence. Bitcoin was in a correction, while the US stock market continued to rise. Eventually, Bitcoin caught up and went on to significantly outperform. This, of course, does exclude the pandemic-driven flash crash, which was a rare and unpredictable event. So, absent another major shock, we believe Bitcoin is currently going through a mid-cycle correction, similar to what we saw in 2019, and it's more likely to catch up to the stock market rather than roll over into a typical 75% bear market. The reason Bravo's research exists is so that a maximum number of people can understand the broader macroeconomic dynamics that are at play and how you should be thinking about it as an investor and as a trader. We provide all of this research on our website, show you how exactly this translates into actual trades that we take, and send you live alerts each time we buy or sell an asset. You can view all our closed trades for free on our website. Our membership provides crazy value for money, and the membership often pays for itself through our strategic trades. Click the link down below if you're interested.